everybody. My name is Graham Allen. I'm one of the regional wealth leaders at IDC, along with Alex Chan out west. And it's a real, it's always a challenge to get great speakers to come and do these things. And we're very, very fortunate to have a really great speaker today. John Natale from Manulife. John's the head of tax and estate on the wealth side. I have known John personally for an awful long time. And you can see why John's got a much nicer head of hair than I have. So obviously things are much better on the Manulife side than have been for me. But what makes me so happy is that when we get the chance to have a true specialist to actually speak to our advisors, bring the right ideas, bring correct and timely information. That's one of the most important things that we can do as an MGA on behalf of our advisors. And I truly feel that there's really nobody else in the business right now that can do it as well as John can. And I mean that most sincerely. So John, I'm not going to say any more because I just want to hear what you have to say. And I'm sure the audience is going to love what the information you're going to bring today. So it's over to you.
Thank you so much, Graham. And I'm just going to try and share my screen here. And that was a very kind introduction. I have known Grant for many years. I always enjoy my interactions with him so much. It always makes me laugh. So thank you all for being on the presentation here today. Very excited to talk to you about the things that I have in my presentation. I have a lot of content to go through, so hopefully I'll get through it all. And without further ado, let's get right into it, because there have been a lot of developments, as you are aware. So here's today's agenda. I'm going to focus initially on some budget updates and principally the proposed increase to the capital gains inclusion rate. Talk a little bit about the annuity settlement option, which again looks even better in light of some of the proposed changes. Prescribed annuities quickly, GIAs quickly, and then hopefully if I have time, we'll focus on some of the resources available for you and for your clients that I think do a really good job of helping you plan for your clients and also helping your clients educate themselves and learn more about the things that we're going to talk about today too. So some of the content is very client friendly as well. Okay. Without further ado, let's go through a quick budget update. It's funny, before the budget came down, many individuals were asking me, John, do you think the capital gains inclusion rate will change? And I said, you know what? It's been pretty quiet on the gossip side, on the down low side. It almost makes me think it might happen. We expected it to happen many years ago. And not that I'm in any way a Nostradamus, but it did happen. I'm not going to lie, I was still somewhat surprised. It has a few kind of idiosyncrasies that we'll talk about today. But obviously, I think the biggest thing that impacted individuals from the budget. Now, again, the key thing is these are proposals. There's been a lot of noise in the media. People have been pushing back with counter proposals and so forth. Justin Trudeau did I think a 3-minute TikTok video. Ms. Freeland subsequently released a statement that they're absolutely going through with these proposals. They're just in the process of drafting the legislation. So just keep all that in mind. So what are their proposals? Well, the proposals are to increase the capital gains inclusion rate from 50% to 2/3 as of June 25th. So effectively for 2024, there's going to be 2 tax years. There's going to be January 1st to June 24th, and then June 25th to the end of the year, and then go forward. For individuals, for individuals, corporations, and trusts, until June 24th, it is status quo. All capital gains are subject to the 50% inclusion rate. As of June 25th, that's when things change. For individuals, the first $250,000 of capital gains, and as of June 5th, the slate is wiped clean, so we start over. So if you had any capital gains before June 25th, they are ignored for that second part of this year, starting as of June 25th. You start with a zero balance, and your first $250,000 of capital gains are subject to the 50% inclusion rate. And every dollar of capital gain in excess of $250,000 will be subject to the 2/3 inclusion rate. For corporations and trusts, this is very important, as of June 25th, every dollar of capital gain is subject to the 2/3 capital gains inclusion rate. There is no $250,000 threshold. So just to repeat, between Jan 1st and June 24th, exactly the same status quo, 50% inclusion rate on all capital gains for individuals, trusts, and corporations. As of June 25th, for individuals, wipe the slate clean, start over. The first $250,000 of capital gains, a 50% inclusion rate. Every dollar of capital gain in excess, 2/3. For corporations and trusts, as of June 25th, every dollar of capital gain subject to a 2/3 inclusion rate. If you realize capital losses, we believe what will happen is the capital losses must be first used against capital gains that year and that tax year, but any excess can be carried forward indefinitely or carried back 3 years. If you apply capital losses to a year, we have the 2/3 capital gain inclusion rate. The capital losses will also apply at that same rate. So $100,000 capital loss will offset $100,000 of capital gain, regardless of the inclusion rate. So some people, in terms of when it comes to planning, particularly when it comes to corporate funds, because you don't have the $250,000 threshold as of June 25th, are wondering whether they should realize capital gains now and take advantage of the 50% inclusion rate as opposed to after June 24th, where they're going to be subject to the 250,000 to the 2/3 inclusion rate. And I'll do some analysis in a few slides to kind of show you some numbers. Ultimately, it's very fact specific. From a personal perspective, if you're thinking about realizing capital gains before June 25th, because you're worried about exceeding the $250,000 threshold, people who are high net worth individuals with huge capital gains, people who have a second property that's not subject to the principal resident exemption might be captured by that. Remember, when you die, you're deemed to dispose of all your assets. And when you leave the country, when you emigrate, you're also deemed to dispose of all your assets. Those are a few timing events that could trigger the capital gains in excess of $250,000. So for individuals, you want to think about alternative minimum tax, AMT. So do think about that if you're making or realizing a huge capital gain. But again, the key thing is no draft legislation yet. People are out there proposing, asking them to change their mind, asking them to defer to January 1st, 2025, asking it to not have to actually realize a sale, but maybe instead some type of election like they did in 1994. So we're all, I think, very curious to see what the legislation will actually look like. So I want to go through kind of some numbers, a numerical analysis or example to help illustrate today versus what it's going to look like in the future and the consequences, because the consequences are fairly significant. So we'll go through a corporate example here. And what I've simply done is I've used a $1 million capital gain example, both at the 50% inclusion rate currently, or if it's realized as of June 25th. Again, this assumes the proposals become law at the 2/3 capital gains inclusion rate. Then you'll see the first thing, obviously, is you have more capital gains to report, an extra $167,000. You're going to pay more corporate tax. And as well, the other big thing, and this is huge, so there's a double whammy from a corporate perspective. The CDA, the capital dividend account, it's a notional account. It's not a bank account. You can't go there and withdraw $500,000 or $333,000. It's a notional or accounting figure. But the CDA is very powerful because whatever the balance is in your CDA, you can pay out a tax-free capital dividend to a shareholder at any point in time. So I'm going to repeat that. Whatever the balance is in the CDA, again, a notional account, you can pay out a tax-free capital dividend to a shareholder at any point in time. You don't have to wait till year end. And the capital dividend account goes up. The legislation basically says the capital dividend goes up by the amount of the capital gain that's not taxable. So currently, with the 50% inclusion rate, 50% of capital gain is not taxable. So half of the $1 million capital gain, so $500,000, increases the CDA account on a notional basis. With the 2/3 proposed capital gains inclusion rate, that $1 million capital gain, 1/3 is not taxable. So your CDA only goes up by $333,000. So not only are you paying more tax, but your CDA goes up by less. So you can pay out less money tax-free. So in this example, you paid a $500,000 tax-free capital dividend, as well as a $400,000 taxable dividend. Here you see you can pay out less, $870,000. The individual, the shareholder, gets the $500,000 capital dividend tax-free, pays tax on the remaining $400,000 taxable dividend, whereas under the proposed rules, you only get a $333,000 tax-free capital dividend. The majority of their dividend is actually a taxable dividend. And at the end of the day, the shareholder pays almost $100,000 more tax, almost a 10% increase. I think about 9.75. So very significant increase in the tax payable and the impact of the capital dividend account. For individuals, we're going to assume they sell a cottage and realize $1 million capital gain. So 50% inclusion rate, you pay tax. Again, these are Ontario tax rates. I'm assuming the individuals in the top marginal tax rate, but these rates are very similar across the country. Currently, you pay tax about $267,000 in Ontario. Under the proposed rules, assuming that the client or individual did not have any other capital gains, the first $250,000 of capital gain on this sale would be at the 50% inclusion rate. The remaining 3/4 would be at the 2/3. And you can see the net tax payable is about $70,000, $65,000 more. And again, that's because they can benefit from the $250,000 threshold. If they otherwise make use of the $250,000 threshold, the tax rate, top marginal tax rate on capital gains actually goes to 35.69% instead of 26.77. So again, about a 9% increase. So they pay about $90,000 more tax. So pretty significant. So, around a 10% tax increase corporately, about a 9% tax potentially, up to 9% individually. But something else I want you to consider. Right now, there's what we call the theory of integration. So what that theory of integration says is the government, from a policy perspective, wants you to be tax neutral as to whether you incorporate or don't incorporate. They don't want the decision to whether you incorporate or not be based on tax. So what they try to say is, hey, currently, if you're going to earn investment income in your corporation, well, the effective combined rate would flow, if you flow it out to a shareholder, is about 29%. If you earned it personally, it's about 27. So there's a 2% differential. So it's not perfect. There's a slight advantage to earning the capital gains personally, but it's not huge. I don't think it'd be, a reason to incorporate or not incorporate. Going forward, the tax rate for corporations is about 38.5%. And for individuals, again, assuming you otherwise make use of the $250,000 threshold, it's about 35.5%, so about a 3% differential. So that differential increases slightly. So not a huge difference. Where the big difference lies is, as of June 25th, you see the tax rate on capital gains is 38.5%. Well, on the first $250,000 of capital gains, so if you can stay below that $250,000 capital gain threshold, your effective tax rate will still stay at 26%. So the tax rate differential is no longer 2 or 3%, it's 12%. Again, assuming you can stay under the $250,000 threshold. So what does that mean in practical terms? Well, when it comes to asset allocation, when you're investing, you might be thinking, well, before I might want to earn, let's say I had $1 million of corporate investments and $1 million of personal non-reg investments. Before, you might be indifferent as to what type of income you earn in either one. Well, now you may want to earn capital gains personally and earn other types of income like dividend income in your corporation. So it's that rebalancing your portfolio, kind of like the analogy would be, with non-reg versus RSP money. Some people say invest, in GICs, interest income in your RSPs, and invest in equities and dividends in your non-reg income and take advantage. So people say, well, when it comes to corporate investing, John, what type of investment income should I earn with my corporate retained earnings? And currently, what we did is we had analysis that said, okay, if you have a corporation, you had money to invest, if you could wave a magic wand and say, what type of income would I want to earn in my corporation that I would make it most tax effective or tax efficient if I floated out from my corporation to myself as a shareholder. So this illustrates the current rules until June 25th. So if I could earn $100,000 of capital gain, $100,000 of Canadian dividend income, so like say from the banks, the insurance companies, the telecom, or if I earn $100,000 of return of capital, $100,000 of interest income, or $100,000 of foreign dividends, so dividends from Apple or Microsoft, wherever it might be, how much tax would I pay, or how much would I be left in my genes as a shareholder at the end of the day? And currently, when you go through all the analysis, and the numbers are all here, and I'll share the presentation with Graham and everybody for you to have. With $100,000 of capital gain, the shareholders left with about $71,000. So the effective tax rate is about 29%. Again, assuming the shareholders in the top marginal tax rate. And again, this is pretty consistent across the country. Eligible dividends are second best, and then return of capital is third best, interest income is fourth best, and US dividends or foreign dividends are the worst. That's currently. So if someone told me I have corporate assets to invest, personally, I'm already in a high tax bracket, I would say all things being equal, earned capital gains, number one, and second would be eligible dividends. But as of June 25th, assuming these proposals become law, all these numbers will stay the same except capital gains because the inclusion rate goes up to 2/3. And you can see the capital gains effective tax rate goes up from 29% to 38.5%. So it's almost at par with eligible dividends. So now if you're in a top tax bracket, I'd say it's kind of 1A and 1B, whether capital gains or eligible dividends are best. And I would also comment that if you're not in a top tax bracket, the lower tax bracket you're in, the more attractive eligible dividends are relative to capital gains. And this ties into my comment a minute ago, is if you have personal non-registered investments and corporate, obviously non-registered investments, you may now want to earn eligible dividends with your corporate investments and capital gains with your personal. So maybe I'll just pause there for a moment if there have questions. I will give you a teaser. I do have an example to illustrate what the break-even point is in case people are thinking, should I realize capital gains before June 25th or not? So I'll pause here to get just a drink of water. In case there's any questions.
John, there's nothing come through right now. I think you've got the full attention of everybody. So
awesome. Thanks, Graham.
That's always good.
I appreciate that. So this example, so people again are trying to say, well, John, this is all good in theory, but I need to know how to advise my clients. And again, the problem in here is we don't have actual legislation. So this is somewhat theoretical at this point in time. And even many tax lawyers and accountants I'm talking to are a bit wary about advising clients until we get the actual legislation. But the problem is June 24th or June 25th is approaching quickly. So I'm going to go through a numerical example. Assume a corporation has $1 million to invest, and it's invested those $1 million and it has an ACB in that current investment of $500,000. So it has a $500,000 pregnant or inherent capital gain. We're going to assume that the shareholder's marginal tax rate on ineligible dividends is 45% when they flow it out to themselves. And the question is, should this corporation realize these capital gains, assuming that the proposals become law, before June 25th at the 50% inclusion rate? Or do they wait and realize the capital gains later? So they defer tax, which is good, but when they eventually realize the capital gain, they're going to be subject to a 2/3 inclusion rate. And the question is, well, how long would they have to wait for there to be a break-even point? So for example, if you're going to sell the investment anyway next year or the end of this year, well, then assuming that the proposals become law, it's pretty black and white that the numbers will say sell now at the 50% inclusion rate. But if you're not going to sell for 10 or 15 years, what do the numbers look like? How long do you have to hold on to the asset to make it worthwhile to defer tax but pay tax at a higher rate? So we're going to assume in this example as well, if you hold on to the investment, you're going to earn 5% a net rate of return. It's all going to be deferred capital gains. Again, just trying to make it for simplicity purposes. So, and I borrowed this from a friend who sent this to me and he said, okay, well, we have that corporation. The corporation could trigger a capital gain now of $500,000. It paid tax of about $125,000 at the 50% inclusion rate, and then it flowed out to the shareholder. You earn 5% for the 1 year. So after 1 year of earning 5% on the $875,000 in the corporation, it grows to $918. You pay tax-free capital dividend. You also pay an ineligible dividend, and the shareholder will be left with $663,000. Versus if you wait 1 year, so you get the full $1 million earning 5% of $50,000, but it's subject to the 2/3 inclusion rate. You see, the shareholder's left with less money, right? And that makes sense because you're triggering that capital gain 1 year down the road. You only have a benefit of a 1 year deferral, and you're triggering a capital gain at a 2/3 inclusion rate. But if you wait 10 years, so you don't sell an investment for 10 years, At that point, the having more money invested in growing outweighs the tax cost of the 2/3 inclusion rate, and you're actually better off by about $3,000. So you would be left with $985,000 in your own hands versus $982,000 if you realize the capital gain before June 25th. So the break-even rate is around 9 or 10 years, which is actually pretty long. Again, from a pure mathematical or numerical perspective. So people are kind of asking what these numbers. Obviously, clients' individual situation are gonna vary, but it's actually a pretty long break-even period where you have to hold on to that asset for it to make sense to wait to take advantage of the tax deferral, but then suffer from the 2/3 inclusion rate. Put another way, if you're gonna sell this investment anyway within the first 9 years, the numbers here would indicate they might as well sell now at the 50% inclusion rate. Now, I know a lot of clients and even myself would be hesitant to do that because who knows what the future holds. We haven't seen the real legislation. Some people have even asked me, what happens if the Conservatives win the next election? Is it possible they could, rescind all this legislation? Anything is possible. So I don't know if I would use a 9-year break-even rate, but I'm just presenting the math. And obviously, it's very assumption driven. The lower your rate of return that you assume, the higher the break-even period, so the longer you'd have to hold on to those assets to make sense, to not realize the capital gains at the 50% inclusion rate, and vice versa. But the other things to consider are, if you don't realize take advantage of the 50% inclusion rate now, and you're going to hold on to it, is there going to be annual portfolio turnover? Are you going to be realizing taxable distributions? If you're turning over your portfolio anyway, 5% every year, well, that's going to increase the break-even rate. Also take into account the situation in the future where if you have too much investment income, if you have active income in your corporation, the small business deduction, so you pay about 12% tax on your first $500,000 of active income, that can be reduced by having too much investment income. So think about that. If you're going to realize the capital gain before June 25th, think about the settlement date. Now remember that settlement date for mutual funds has changed to 1 day from 2 days. People have asked me, John, capital losses, should I realize capital losses now? Should I wait? The short answer is there is no downside to realizing capital losses after June 25th. If you need to realize the capital loss now anyway, by all means do so. But then those capital losses, I think, will first have to be used against capital gains in this tax year from Jan 1st to June 24th. But if you can wait to realize your capital losses, I would wait till June 25th, all things being equal. And again, the big caveat here is we don't have any actual real legislation. So it's hard to say anything with any certainty. So that's from a corporate perspective. From a personal perspective, again, there's the $250,000 threshold, but for some individuals, they could be in that situation, or people who are getting, individuals who are much older, have significant non-registered assets. Before TFSAs came around, people say, John, I love all the benefits that seg funds or GIAs offer. The insurance company GIC is what we call a GIA, but I don't want to realize that capital gain on my non-registered investment portfolio doesn't make sense. And obviously, by moving to the seg fund, you get or the GIA, you get all the probate fee savings, executive fees, legal fees, accounting fees, but you get a whole bunch of other benefits: quick death benefit payout, creditor protection, possibly privacy, and so forth. So the example I went through, I said, well, let's go through an example and say, what happens if someone had $1 million non-registered personal portfolio with an ACB of $900,000? That's $100,000 pregnant capital gain. And let's say they're 80 years old. So I'm not an actuary, but let's just say their life expectancy is 5 years. Well, if they realize that $100,000 capital gain now, well, $100,000 capital gain, 50% inclusion rate. So 50,000 is taxable. If I assume they're in a $50,000 tax bracket, they're going to pay $25,000 of tax. Now, they're not paying extra tax. They're going to pay that tax at some point. If they fund switch or sell or die at some point in the future, they're going to pay that tax. So they're not paying additional tax, but they're prepaying tax. So the actual tax cost of realizing that $100,000 capital gain now is the opportunity cost of prepaying $25,000 of tax now versus paying it 1 year, 3 year, or let's say their life expectancy is 5 years down the road. So what's the opportunity cost of paying $25,000 of tax now versus paying it, let's say, 5 years down the road? Put another way, if I cut you a check for $25,000, Mr. and Mrs. Advisor, how much could you earn after tax on that $25,000 after 5 years? If I assume a 5% rate of return, 5% net rate of return on $25,000 is $1,250 a year. If I multiply that by 5 years, that's $6,250. That's my opportunity cost of realizing the capital gain now versus moving into a seg fund and GIA and taking advantage of all the benefits that offers. And I think a lot of people are shocked by how small that opportunity cost is. So we have an article that talks about this. This is linkable when you get the presentation as well too. It kind of goes through a numerical example to help illustrate what I just talked about. I actually ran the numbers instead of just speaking to this, but I ran with these numbers off the top of my head. I ran the numbers. So you have an 80-year-old investor with that $1 million investment, fair market value with a $900,000 ACB, and a pregnant $100,000 capital gain. And I said, let's assume her life expectancy is 5 years, but let's assume she earns a 6% rate of return. And let's assume it's all deferred capital gains. Well, when she sells it 5 years down the road, in this example, I'm assuming she dies, but she could otherwise sell it. You can see it grows to $33,000, triggers an $8,500 capital gain. Half of that is taxable, pay tax of 50%. The net opportunity cost here is $6,300. So there is a cost, but it's only $6,300. It's not nearly as high as people think. And again, by moving to the seg fund or GIA, you get all the estate planning benefits, you get the fee savings, can use potentially the annuity settlement option. So lots of really nice benefits. And we have a calculator that does all this for you. And then actually can calculate the opportunity cost for you as well. And if you've never used this estate cost comparison tool, the link is here. Myself, Manulife Wholesalers, we can help show you how to use the tool. It produces a really nice report that you can PDF and send to your clients as well too. So, and you get to choose all the assumptions, the executor costs, the probate fee, so you can make it province specific. You can assume no executor costs. And then again, you take into account the monetary benefits, but also the non-monetary benefits, the quick death benefit payout, the privacy, etc. So a really, really powerful tool. So again, I'll pause there really quickly, just for a quick glass of drink of water. You're on mute, Graham. Okay.
Yeah, I'm on mute. I just don't want to disturb you too much. A quick question came through. I think it's a good one for you. It's from Colin. John, does the higher inclusion rate for high net worth investors increase the benefit of donating securities in kind to registered charities?
So great question, Colin. And I would say personally, I would say absolutely, right? Because you have a situation. Let's use a $10,000 example, and we can talk about seg funds. We can talk about stocks. We can talk about mutual funds. Let's just say you had an investment of $10,000 with an ACB of 0. And we'll use, let's say, Manulife shares from demutualization as an example. But again, you could have a mutual fund, a seg fund, or whatever. If you sell that investment and trigger the $10,000 capital gain and donate the after-tax proceeds to the charity, that's going to be not nearly as attractive as donating the securities in kind, 0% capital gains inclusion rate, and the full charitable receipt. The tax cost of selling that investment with the 50% inclusion rate going to 2/3 is only going to increase, which means the tax savings by donating in kind, when you compare donating in kind versus selling the investment, donating cash, the tax benefit's going to increase. So 100%. And the thing I'll say to you about this as well, and this is a lot of people don't know this, you can donate in kind with corporate assets. So you can donate seg funds in kind, mutual funds or stocks. And when you donate investments in kind with your corporate assets, okay, you get the 0% in capital inclusion rate, just like you and I do as individuals, Graham and Colin. The fair market value of the donation, you get a charitable receipt for, just like you and I would do personally. Now, the corporation gets a deduction. We get a credit, but it works the same. It reduces your tax payable. So you have those two benefits. But with the corporation, there's a third benefit. And this blew my socks off. I'm not joking when I first saw that. Remember in the corporate situation, normally capital gains, 50% taxable, it's going to go up to 2/3. And the amount that's not taxable increases your CDA. So currently your CDA goes up by 50%. When a 2/3 inclusion rate comes into play, your CDA will go up by 1/3. Well, what happens when you donate securities in kind? There's no capital gains, 0% capital gains inclusion rate. Well, the Income Tax Act says the CDA goes up by the amount of capital gain that's not taxable. So if your capital gain inclusion rate is 0, your CDA goes up by 100%. I thought it was too good to be true. It literally knocked my socks off. So the third benefit of donating in kind with corporate funds is 100% bump in your CDA. So it's really powerful from a corporate perspective. So great question.
That's it for now.
Thanks, Graham. Okay, so the last part is I want to touch on a little bit the annuity settlement option. You may have heard me talk about this a little bit more, but again, the changes in the proposals of the increasing capital gains inclusion rate, I think, make this more attractive. So I'll touch on this briefly, GIAs and a few other things as well too. So the annuity settlement option, again, I hope everybody's familiar with it. It is not a product. Okay, we've just modified the beneficiary designation to our seg funds, to our GIAs, and to our life insurance policy. And basically, it's a way to control from the grave. And the way I speak to this, I say is, I'm sure you have clients who come to you all the time and say, for whatever reason, I know I want to give my assets to when I pass away, but I don't want a certain individual or individuals to receive a lump sum. And how do I control from the grave? And the first idea that comes to mind probably are trusts. And trusts are a great estate planning tool to control from the grave. The downside is you have to see a lawyer. And I'm a lawyer, but you have to see a lawyer. You have to pay legal fees. You have to identify trustees. You may have to pay trustee fees. You're gonna have to file a trust return. I'll talk about that in a second as well. And they're very inflexible when you set them up. So usually people don't set up a trust for estate planning purposes unless there's a certain threshold of assets. $750,000, $1 million, 1.25, whatever that threshold is, in order to make the cost benefit analysis work. Well, the annuity settlement option is another arrow in your quiver. It's a free option. It's simply a beneficiary designation, so you can change your mind at any point in time. And what it allows you to do is it allows the death benefit paid from a life insurance policy, a seg fund or GIA, to be used to buy an annuity, which is a new commission, a new sale, and annuities purchased based on the instructions you provide. Okay, and once that annuity is set up for the beneficiary, they cannot monetize it. It's non-assignable, non-commutable, and non-transferable. So they are locked in. And there's great flexibility with this annuity settlement option. You could have two beneficiaries. One gets a lump sum, one doesn't. Or the one that doesn't, part of it could get a lump sum and part of it could be in the form of an annuity. There's incredible flexibility. You can even designate who the beneficiary of the annuity is. So I had a client tell me, I want to set up the annuity settlement option for my son. It's going to be a 10-year term certain annuity. I don't want, in case my son dies prematurely, I have to say after 2 years, those 8 years of guaranteed payments on term certain annuity, I don't want it to go to my daughter-in-law. Her and I do not get along. I want it to go to my grandchild. She could designate the beneficiary of the annuity being the grandchild, and that grandchild would be named irrevocably on the annuity. So her son cannot change the beneficiary. And it works really well with non-resident beneficiaries as well. And you've heard me talk about this maybe before as well. Non-resident beneficiaries are a real risk to executors when it comes to liability. There's a lot of court cases out there on that. We set up the annuity for the non-resident beneficiary, even though normally we can't set up new contracts for a non-resident. We consider an extension of the current contract. We do all the tax reporting. We issue the NR4 slip. We do the remittances and withholding to CRA for withholding tax. So we remove a huge obligation from the executor. So it works really well with non-resident beneficiaries. Now, if you want to give them a lump sum, seg funds and GIAs are great too, because with non-registered assets, they get the money tax-free. All the tax reporting is to the deceased, and we can pay that within a couple of weeks. Again, so really good for lump sum or annuities for non-resident beneficiaries. The reason I want to bring it up as well too is that you might not be aware is we just updated our form. So this is a new copy of the form. I think it's a lot better to use. It provides a lot more flexibility that you can do right on the form. You can see here you identify like a normal beneficiary designation. You identify your normal beneficiary, so primary beneficiary number 1, okay, and you indicate whether you want them to get a lump sum or an annuity. And if you choose an annuity, you pick the type of annuity you want right here. And the same thing with beneficiary number 2 or number 3. And again, like any other revocable beneficiary, you can change your beneficiary at any point in time. So very, very flexible. Hull & Hull, for those of you in Ontario, they have a great blog. I subscribe to it. It's probably one of the top law firms in Ontario. In fact, Ian Hull, a founding partner, I think won an award this year for a Lifetime Achievement Award for estate planning contributions to the Law Society. They talk about using annuities as an estate planning tool. They actually reference Manulife Investment Management, and they actually talk about the annuity settlement option. And the reason I bring this up is a lot of advisors found this very friendly to share with their clients. It adds credibility to this strategy. You can Google Hole in Whole. I can provide a link or a PDF of this piece if you want, but you can also Google it as well. So a lot of advisors have found this really helpful when it comes to communicating the benefits of the annuity settlement option, the credibility that it offers. And then again, when you're comparing, and they're both good options, a trust versus annuity settlement option in terms of an estate planning tool, and they're both good options. They both have pros and cons, both of them. But the scales may have tipped a little bit in favor of annuity settlement option in light of recent legislation. So the first thing is, you'll probably recall earlier this year, all trusts had to file a T3 tax return. There are very few exemptions. If the trust had been in existence for less than 3 months or had less than $50,000 of assets, or graduated rate estates or qualified disability trust, they were exempted. But otherwise, all trusts had to file a tax return. Even bare trusts, mind you, at the very last minute, and this was a very painful thing for clients and tax advisors, at the very last minute, the government said, oh, we'll give you a 1-year exemption on bare trust filing. So it's not a permanent exemption, it's a 1-year exemption on bare trust filing. And you can say, well, what qualifies as a bare trust? Because people were shocked by this as well too. So I'll give you the 2 most common examples of bare trust that will have to file a trust return next year. One is the situation where parents, oftentimes they'll name an adult child or someone as joint owner on anything, real estate, bank account, investment account. And the idea is they don't really want to give ownership to that new joint owner. It's done strictly for estate planning purposes. So when the client passes away, it flows outside their estate and goes directly to that joint owner. That's considered a bare trust, okay? And there would have to be trust reporting there. Again, the idea here is the client actually maintains ownership. It's really done for estate planning purposes. And the other common one is you have children who want to buy a property, couldn't qualify for a mortgage or financing. They would name their parent as joint owner. But again, it really was the child's property. The parent there was only entitled on title for legal purposes. They didn't really have a beneficial interest in it to help the child qualify for financing. That too would be considered a bare trust. And again, there'd have to be tax reporting every year after this year. And the tax reporting is onerous. You have to identify all settlors, all trustees, all beneficiaries, including contingent beneficiaries, their name, address, date of birth, and SIN. And the contingent beneficiary is very important. They call it the disaster clause. For example, my father-in-law has 4 kids and 10 grandkids. If he had a trust that said, I split my estate, or I contribute assets to the trust, and the trust is to be distributed equally between my 4 kids, and if one of my 4 kids predeceases me, it's to go to their children for stirpies. Well, now he has to have the person filing a tax return has to have the name, address, date of birth, and SIN of all the children and all the grandchildren, even if there's the slightest chance that they're going to get the money. And I know accountants often many of them are charging $750, $1,000 to file every trust return. So when you think about that cost benefit analysis, annuity settlement options might look a little bit more attractive. As well, when you think about a joint investment instead of a seg fund, you don't have to have a joint owner. You can just name that individual as beneficiary. Because again, if you have a joint ownership and it's a trust, you have to do the trust reporting. But as well, if you set up an alter ego, a joint partner trust, in the year of death, those assets will be taxable at a 2/3 inclusion rate, not a 50% inclusion rate in the year of death. So normally with alter ego and joint partner trust, while you're alive, the income is flowed back to you at your personal rate. So you can get the 50% capital gains inclusion rate up to the $250,000 threshold. But in the year of death, the capital gain has to be taxed in the trust, and that's subject to the 2/3 inclusion rate if this proposal comes into play. So again, lots of reasons why seg funds or GIAs may be better than a trust, an alter ego trust, or a joint partner trust as well. So I'll pause there quickly, get another quick drink in case there's any questions, but I know I've gone through a lot of different things there and some new content for you.
There's another question for you, John, from Colin again. So Colin's used an annuity settlement option in the past.
Yeah.
It was set up with a 15-year deferral period to allow younger children named as beneficiaries to reach the age of majority. What happens to the proceeds of the seg fund upon death until the end of the deferral period. Does it actually earn any interest? How's that held before it's paid out in the annuity option?
Yeah, really good question again, Colin. So a couple things actually. So remember, it is a brand new annuity sale. So when the contract owner and annuitant of the seg fund dies, let's say the death benefit was $1 million, just for simplicity purposes, you buy a brand new annuity based on annuity pricing at that date and time. It'd be no different than if Graham and I coincidentally bought $1 million annuity on that exact same date on the exact same individual. It's a brand new annuity based on annuity pricing at that time. So you could run an annuity quote, you get a 15-year deferral. The amount of income it earns will be based on annuity pricing at that point in time. So obviously, if you bought that annuity today versus buying that annuity 5 years ago when interest rates were a lot lower, the annuity you bought today is going to look a lot better than the annuity you would have bought 5 years ago, because annuity rates or interest rates were a lot lower last year, 5 years ago, if that makes some sense. So hopefully that makes sense. So think of it also like a GIC or GIA. The other important point I do want to make, if you buy a deferred annuity, you can do that 100%, but you do want to consider a couple things. One, during that deferral period, it will be considered non-prescribed. So it's a great segue to my next couple slides. The client will get a tax slip during that deferral period. So you want to make sure they have some cash flow to pay the tax slip that they're going to get on an annual basis. And the last thing I'll mention, actually, and I've been at Manulife for 23 years, so Graham and I have go way back, but I just learned this last year. Someone said to me, John, I like the idea of deferring payments to the beneficiary, but I don't want to buy a life annuity or a term annuity. I just want to defer payments for 5 years, but I want it to be a one lump sum payment, but 5 years down the road. So basically almost like a 5-year locked in GIA. And I reached out to our annuity person, Nada, and she said, John, we can do that. And that led to a sale. So it was, very, very exciting. You do have to qualify for our annuity underwriting rules. So our maximum deferral period currently is 15 years. So you still have to qualify with those rules. But I know hopefully I answered your question and gave you a little bit more background. But just the flexibility that the annuity settlement option is incredibly powerful. So I hope that helps, Colin.
Obviously, I know Colin said it did mention to me privately that he's going to be meeting with Mr. Shimon, I think next week. So there'll probably some questions from that meeting to come to involve you with as well after that happens.
Happy to help.
That's it for now. Back to you.
Thanks, Graham. Okay, so what a beautiful segue. Prescribed annuities. So again, I'll kind of go through this a little bit quickly because I have talked about it in the past, but I think there's some really nice nuggets here. So when it comes to non-registered assets, you have either prescribed or non-prescribed, and you have to qualify for prescribed. And generally speaking, prescribed are tax preferred, and I'll talk about that in a moment and explain the differences between prescribed and non-prescribed. But let's focus, on prescribed for the moment. So the one thing I want to say is, when you're 65 or older, annuity income qualifies for the pension income credit, which means it automatically qualifies for pension income splitting. Obviously, the older you are, the larger the premium amount, the greater the annuity payments. And obviously, there's other factors that go into annuity pricing, like interest rates and things like that. And so this is some annuity quotes for a male, $100,000 single life, 3-year guarantee period, prescribed annuity. And you can see the older they get, the higher the gross income, the lower the taxable income. In fact, for an 80-year-old, you get $9,800 of gross income, all tax-free. So none of it would be taxable. So your net rate of return is 9.8%. And the nice part is none of it is taxable. No negative impact on income-tested benefits like OAS or the age credit or nursing care costs or any other income-tested benefits as well, medical tax credits. So really, really powerful. Obviously, the downside is you have to give up access to liquidity. But if you have clients who are trying to maximize yield and after-tax income and are worried about longevity risk, annuities can be a nice complement to their investment portfolio. Again, the higher the income, the more attractive it is. And people are often blown away by the 0% taxable portion, but that is accurate. And one of the guarantees, and I want to make sure when people run an annuity quote, if they're interested, is think about the principal protection, or what used to be called the cash refund guarantee. This is a very powerful guarantee. And how does that work? Well, it's actually pretty simple. In some ways, it's actually easier to explain to clients. The cash refund or principal protection guarantee works. I'll give you an example. I use $100,000 to buy an annuity. It's going to pay me $10,000 a year. If I die after 2 years after receiving $20,000 of payments, the guarantee is worth the difference between my premium amount of 100,000 and what I received of 20,000. So the guarantee is worth 80. If I die after receiving 70,000, the guarantee is worth 30. If I die after receiving $110,000, the guarantee is worth 0. So put another way, when you buy an annuity, a life annuity with the principal protection guarantee, you can guarantee the client that between them and their beneficiaries, worst case scenario, they're going to get their money back. Worst case scenario. Because that is one of the common objections with annuities is what happens if I die prematurely? Obviously, you can buy a life annuity or with a guarantee period or term certain, but the principal protection can work out really well too. It's easier to explain. But without getting too technical, the other thing is, unlike a term certain annuity or a life annuity with a guarantee, like a 15-year guarantee, the principal protection, this is a little bit of a tax geek thing. It has no negative impact on mortality tables, so it can actually be more tax efficient. And I'll show you what I mean. If I have a male age 64, if I bought a life annuity with a 15-year guarantee or a life annuity with a principal protection guarantee, you can see the gross income on the 15-year guarantee is higher. The total guaranteed payments with the principal protection is higher. It's 100,000. 94,000 is just 15 years times 6,300. So you're actually guaranteed an extra $5,300. But the taxable portion, because there's no impact, negative impact to the mortality table, is less. You pay less tax. Your after-tax income is actually higher. So more after-tax income, greater guarantee, and maybe greater benefit in terms of preserving OAS benefits as well too. So really, really powerful. I always encourage people when they run an annuity quote to run one with a guarantee period, but also with the principal protection, because you never know how the numbers are going to work out. And when people look at prescribed versus non-prescribed, if you look at a textbook, you'd say, okay, well, the benefit of prescribed is you have what's called level taxation. The taxable amount is the same every year, whereas as non-prescribed, you have more taxable amount early on and less later on. All things being equal, the idea is you pay the same amount of tax, like the income inclusion is the same if you live to age 100, but everybody would prefer to pay less tax early on. So people think there's a tax deferral advantage with prescribed annuities. But I'm going to challenge that. I actually ran some annuity numbers, and this is actually, in fact, what it really looked like. The prescribed had level taxation. The non-prescribed, again, had higher taxation that goes down, but they intersected not at the halfway point, but instead at like an age of 104. So if you died any time before this, not only do you have tax deferral, you have net tax savings of prescribed versus non-prescribed. And I don't hear anybody else talking about that as well too. So you generally want to qualify for prescribed if you can, and say, well, when would you not qualify for prescribed? Well, these are the things that will disqualify you from prescribed treatment. If you have a guaranteed period that goes beyond your 91st birthday, an indexed annuity cannot be prescribed, a corporate-owned annuity and certain annuities owned by trust cannot be prescribed, and a deferred annuity cannot be prescribed. However, a deferred annuity, once it kicks into payout stage, if it otherwise qualifies for prescribed, you can ask for the tax treatment to change to prescribed. You just have to let us know. We've actually done that. And the annuity quotation system, if you want to run annuity quotes, is available on Worldsource, or you can reach out to your Manulife wholesaler as well. So I'll pause there quickly. I just get a quick drink because I do want to talk about GIAs because I'm super excited about GIAs. But Graham, I'm happy to answer your question if you have a comment.
So we'll get right to the question. It's from Gordon. What is the consequence of having a bank GIC in a holding company where two children are beneficiaries of assets?
Well, the consequence, I assume the tax consequence. So interest income is the least, well, US or foreign dividend income is the least tax efficient. Interest income is the second least tax efficient income to earn in your corporation, right? So whether it be a bank GIC or even an annuity income is going to be fully taxable in your corporation. An insurance company GIA reports it as annuity income. So the downside with having a GIC type investment in your corporation is tax inefficiency or high tax rate. You saw there's a slide at the beginning where I talked about when you flow that income out to the shareholder, capital gains are best and Canadian dividend income are second best. Now, the upside to GICs is there's no market risk. So it really depends on what the client's risk profile is and whether a GIC is the right type of investment. But all things being equal, from a tax perspective, capital gains and Canadian dividend income is by far tax preferred. So it's no different really, to be honest, than you or I or clients in the top marginal tax rate. What's the difference between earning GICs versus earning dividends or capital gains. You get no market risk, but very inefficient from a tax perspective.
So maybe an opportunity then.
100%. And then the reality is most business owners don't even have money in GICs. They have it in checking accounts or high interest savings accounts. And I would argue that tax efficiency in your corporation is actually even more important than personally. So if you could earn 2 or 3% capital gain, that's equivalent to a 4 or 5% GIC. And I think over a long term, I think many advisors think they could do that. But again, I leave that for people, smart people like you and the advisors on this call.
I think there's a couple of questions come through, but I'd like to let you finish your presentation, John, before we do any more. Okay.
Yeah, I'll go through. Yeah, perfect. I'll try and stop with a couple minutes left. Just the GIA part is really powerful, and there's a couple resources at the end that advisors can look at when they get the presentation. So GIAs, really simply, and this blows people's minds. Non-registered GIAs, insurance companies report as annuity income, so qualifies for pension income credit and pension income splitting if you're 65 or older. So federally, the first $2,000, you get a $300 tax credit. Plus you get the provincial credits. You see I put Ontario, Nova Scotia, and BC. If you earn $4,000 of annuity income, you can split $2,000 with your spouse. And if they're 65 or older, they can also take advantage of the pension income credit, which is great. So you multiply the savings. Furthermore, our Manulife Seg Fund GIA contracts are combined into one contract. So if you have a client who has $1 million GIA and $200,000 of Seg Funds, the $1 million GIA contributes to the management fee reimbursement. So it helps reduce the MER slightly as well too. But let's focus on the tax benefits of a GIA. And before I get to the pension income credit and pension income splitting, another benefit that they offer versus a bank or trust union, trust company or a credit union GIC is that you have the benefit of or potential for 1 year tax deferral in the first year of your GIA versus a bank GIC. And I'll use this slide to illustrate this. If I buy a GIA in December, let's say I bought December 15th of 2023, we use policy anniversary date. So my policy anniversary date would be December 14th, 2024. And any income I earn in those 365 days will be reported on my 2024 tax return. If I can wait till January 2nd, 2024, my policy anniversary date is January 1st, 2025. Any income I earn in those 365 days will be reported on my 2025 tax slip and on my 2025 tax return, which I file in early 2026. So you can actually defer income for an additional year in the first year, which you often can't do with a bank or trust company or credit union GIC. So there's a potential for a 1 year tax deferral in the first year. But the other big benefit is the pension income credit and pension income splitting. I'll go through a simple numerical example. Take a client, 65 years old, they have $1 million in a GIC that's up for renewal. They're married, they're in a 50% tax bracket, their spouse in a 20% tax bracket, and thinking, oh, I might want to buy a GIA because of the pension income credit and pension income splitting. In addition to the estate planning benefits, you don't have to worry about joint ownership. You don't have to worry about probate fees, executor fees, lawyer fees, annuity settlement option, all the other disadvantages that come with regular GICs. So we say, okay, well, look, what if you bought a GIC, you renewed at 4%, and don't worry about the exact rate, or you got a GIA from Manulife at 3.8, because oftentimes our GIAs are a touch below. See, well, if you earn $40,000 of interest income, 50% tax bracket, you're going to pay $20,000 of tax and net $20,000. Well, if you earn $38,000 of annuity income, you split half of it. Your wife is in a much lower tax bracket, or your husband, in this case, it's the wife, you're saving $4,700 a year. What if one of you can claim the pension income credit, but you otherwise couldn't? And again, I'm assuming Ontario, your tax benefit each year goes up by $5,000. And let's be really optimistic. What if you both qualify for the pension income credit now, and the GIA is the same rate as a GIC, which sometimes happens? Your annual after-tax benefit is almost $6,800. Huge tax savings in addition to all of the other estate planning benefits that GIAs offer. And there was an interesting article in the Globe and Mail the other day that talked about a lot of taxpayers. The downside of higher GIC rates is they didn't realize you're going to have to pay more tax when they filed their 2023 return. They got the OAS clawback. When I was thinking, this was screaming for talking about GIAs and the potential benefits of pension income splitting. So I'll pause there. I know we're at time. I'll share the presentation, and Graham, I'll turn it back to you, and I'll try to answer some questions as well quickly.
And I got the feeling we could have kept this going for another hour, you know that? But because the information is just so useful and applicable to what everybody in the line is actually doing in their daily duties. So let me just hear. First question, John, do you understand why CRA is keeping the pension income tax credit at 2,000 rather than indexing it like most other tax credits, like age credit?
So great question. I can only speculate. I can only speculate that it would cost them money if to index it, but I think they should. And I think many of us think that they should as well too. And there's a few other items that people think should be indexed. You saw that they increased the lifetime capital gains exemption to $250,000 as well too. So I think that would make sense from a policy perspective. It's good too because you're helping seniors. So I hope they do, but I think right now it's just they haven't turned their mind to it, and also it would cost them some tax dollars. That's my speculation.
One other question here, and just maybe it's more of a clarification. For the annuity settlement option, can a non-resident be a beneficiary?
100%. So if I wasn't clear about this, I apologize. And I was trying to use that example. If you have a non-resident beneficiary, even though normally we can't buy an annuity for a non-resident beneficiary, this is an exception to the rule. So they can be the beneficiary and set up an annuity for them. And then the other benefit is, and this is a real win, is we do all the tax reporting. We do the issue the NR4 slip. We do the remittances to the CRA. So it removes a huge burden from executors if they were trying to replicate that through the will.
Another question here. I just want to split. I think this will be the last one. If you sell, maybe if you sell an investment to trigger a capital gain before the 24th of June, how long do you need to wait before you can reinvest in the same fund, or is there no time frame?
Great question. Short answer is no time frame. There's no such thing as the superficial gain rule like there is for the superficial loss rule. The only thing I would say is don't wire it to yourself. If you do it on the open market, so you sell and buy back the next day, or you sell stocks and buy stocks again separately, you're fine. There's no such thing as a superficial gain rule, 100%.
Well, I think we are bang on. We are bang on time. John, thank you. Thank you so very much. I can only imagine that there's a ton of questions come out of this. I do hope that the Manulife sales force are inundated with questions. That's what we want. We want this stuff to trigger action, to drive, drive work and ideas. Maybe add some more bows or arrows for the bows that are being used out there for the toolkit. There's just so much that I know you could have gone on further, and we're always limited in time. I will say I look forward to the next session whenever we can get your talents online for us again. As I said, personally, I just really do enjoy being involved in the sessions that you're on, John. It's very much appreciated, and that's on behalf of all of us here at IDC. And I'm assuming the over 100 people that were actually on the line today to listen as well. I hope it's made a difference to their jobs and the revenue possibilities in the year going forward. So thank you very, very much, and have a great afternoon, everybody.
Thank you so much, everybody.